The cost-plus method is a widely used approach in transfer pricing, particularly for transactions involving tangible goods, intercompany services, and manufacturing activities. The method focuses on determining the appropriate markup on costs for related party transactions, ensuring the transaction adheres to the arm's length principle. In this context, the method is primarily used to assess the gross profit margin, which should not be confused with the Transactional Net Margin Method that assesses net profit indicators. This distinction is critical, as the two methods are often mistakenly used interchangeably, despite their different applications and outcomes. The cost-plus method calculates the transfer price by adding an appropriate markup to the costs incurred by the supplier of goods or services in a related party transaction. It compares the markup on costs with those obtained in comparable uncontrolled transactions between unrelated entities. To apply this method, a business first identifies the direct and indirect costs associated with the production of goods or the provision of services. A reasonable profit margin, markup, is then added to these costs to determine the transfer price. For instance, if a company incurs $100 in manufacturing costs and applies a 25% markup, the transfer price for goods sold to a related party distributor would be $125. Manufacturing entities. It is often applied in cases where one related entity produces goods and sells them to a related distributor. The costs of production are calculated, and a standard markup is applied to determine the sale price. Service providers. The CPLM can also be employed for service transactions, such as research and development R&D services or management services between related companies. The total service cost is marked up by an appropriate percentage to arrive at the arm's length service fee. The first step is calculating the total cost incurred by a company to produce goods or deliver services. These costs can be categorized into direct costs, costs that are directly associated with production, such as raw materials, labor, and freight. Indirect costs, expenses like administrative fees, rent, and maintenance. The second step is determining a reasonable markup to add to the base costs. This markup is intended to reflect a fair profit margin. In most cases, the markup is derived from industry benchmarks, considering factors such as market conditions and profit levels in comparable transactions. The challenge here is selecting the right margin, as it must be defendable during tax authority reviews. It is essential to distinguish between the cost-plus method and the Transactional Net Margin Method, as these two methods are often conflated but serve different purposes. The cost-plus method tests the gross margin, meaning it examines the profit relative to costs directly linked to production or services. In contrast, the Transactional Net Margin Method typically evaluates the net profit relative to an appropriate base, such as sales, costs, or assets. In the cost-plus method, the focus is on gross profit or gross margin, which is the profit after direct production costs are subtracted, but before operating expenses like selling, general and administrative costs are considered. The Transactional Net Margin Method, on the other hand, looks at net profit, which includes all operating expenses. Therefore, while both methods address profitability, the cost-plus method operates on a gross level, and the Transactional Net Margin Method works at a net level. For the cost-plus method to be applied effectively, transactions must be sufficiently comparable. Comparability factors include nature of the goods or services. The transactions being compared must involve similar products or services. Functions performed. The functions performed by each party in the transactions, such as production, logistics, and sales, must be comparable. Risks assumed. The risks undertaken by the parties, such as market, operational, or financial risks, should be similar. Market conditions. The economic and geographic conditions in which the transactions occur must be comparable to ensure the relevance of any third-party benchmarks. The cost-plus method has certain advantages. Simplicity. It is relatively straightforward to calculate the costs and apply a reasonable markup, making it easy to implement for many businesses. Direct applicability. For manufacturers and service providers, it is often the most logical method, as it ties the transfer price to actual production or service costs. However, there are also some drawbacks. Limited comparability. The method relies heavily on finding comparable third-party transactions, which can be difficult in cases where unique products or services are involved. Focus on gross margins. The cost-plus method only considers gross margins, which means it does not take into account the full range of costs and risks that might be relevant to determining an arm's-length price. The cost-plus method remains a widely accepted and frequently applied method in transfer pricing, particularly for manufacturing and service transactions. However, it is essential to understand that it differs fundamentally from the Transactional Net Margin Method, TNMM, which tests net margins rather than gross margins. Companies must carefully consider which method is most appropriate for their transactions and ensure that they apply it consistently and with due regard for the arm's-length principle. By doing so, they can minimize the risk of transfer pricing adjustments and ensure compliance with international tax regulations.